This time is different, first of all, which is not. So I don't buy that. It's the narrative we hear all the time. We hear it again and again. This time is different. And then something comes up, and then we see that it's not different. The cycle, probably holds. And I think, within the next 50 days, you could probably see a top in the Bitcoin, and it could be a much higher level, as I said, than where we are now.
Henrik Zeberg's central theme is the growing disconnect between financial markets and the real economy. Tech giants and risk assets are being bid up by liquidity and speculative flows, but the underlying fundamentals of consumption, employment, and housing are deteriorating. One striking data point: a new study shows that 15.6% of U.S. households cannot reliably afford food. That's worse than the 13% recorded during the 2008 financial crisis. This isn't a marginal issue. It's a sign that the consumer base, which makes up roughly 70% of U.S. GDP, is under severe pressure. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
So right now we're seeing that the environment has been very toxic, I would say. And the toxic is when you look at the real economy, which is the consumer. Talking about, again, as I said, 15.6% in a new study shows that 15.6% of the US population is not able to provide to get food on the table, which is a severe problem. That's bigger than going into the financial crisis, which was at 13%. When you look at the yield levels that people have, the rates that people are paying right now, if you look at the housing market, the existing homes sold, it is, as I said earlier, it is at very low levels. It's 4 million units sold in 24, and at this point it's lower than that. And in a population that is now 100 million bigger than when we earlier saw 4 million. So things are at a standstill. You have the affordability index. It's down the gutter. It's lower than in the 1990s. We need to go back to the 1980s, where it was really a bad time. These are the things. This is the real economy, and everybody seems to think about what Nvidia, and you talked about Facebook or Meta and so on. These are the things that are being driven by liquidity, and that is the big schism here. Will liquidity by the end of the day drive it, or will it be the real economy? And what I'm a proponent of is that the real economy is rolling over. There's 100%, you can look at all the indicators. Look at the non-farm payrolls revision today. That is not a good thing. You have had in May, you had a standstill almost already in non-farm payrolls. In May, June, July, the same. This is not a good thing. So the economy is, and what will happen? Well, at some point, you're going to see that we'll start to see that the economy is rolling back, and that'll be on the labor market. You start to see negative numbers coming out. And what the Fed will do is that they will try to stimulate it at some point. They'll be late, and they will see that they cannot do it, because by the end of the day, we have to understand the only thing that will help if the consumer starts to spend more. What should they spend if 15.6% can't put food on the table? And why should the companies start to hire people in? They have overcapacity at this point. The capacity utilization in the US right now is at 77%, which normally when it goes below 80%, you'll see that they start to lay off people. Where should the money come from? And then we say the Fed. Well, as I said, Mrs. Johnson now, she saves $100 on her mortgage loan. Will she go out and say, okay, I'm going to spend this, having seen inflation, having seen yields go up, having seen maybe her neighbor getting laid off, or her husband, or whatever. And then she says, you know what? I'm not only going to spend this one, I'm going to borrow an extra $100, and then I'm going to go spend those two, putting myself into more debt, when she's already more in debt than she's ever been before. There's nothing that supports the argument that QE can actually keep supporting an economy and the economic growth, especially when you start to see it really coming into the real part of the economy, which is the consumer, and that we do now. We haven't seen that earlier. I was not one of the guys talking about recession in 22 or 23 for that matter. I said, no, not this time, because we still have the cycle still moving higher, but now it's rolling over. And in the next few months, we're going to see the non-farm payrolls getting worse and worse. You'll see the blips up and down, and then they'll be revised and so on. And all of a sudden, you'll see the stock market will put in the top. It can be at a very high level, and you can see the euphoria develop, which is, I think, we're going to see. You think Bitcoin can go to 160,000, and you'll see people be euphoric. and thinking, okay, I'm a billionaire or a millionaire, or how much they will become, and everything is fine. But that's actually not fine, and it's not fine that the central banks are starting to ease, because that they only do late phase and late cycle, because they are always late and they can't save it. And you saw that in 2001, you see it in 2007. We've seen it every time we had late phase, late cycle. They are late.
He predicts that negative prints are coming, an inflection point where unemployment starts to rise. Historically, once layoffs begin, the trend accelerates, consumer confidence drops, and spending contracts further.
This time is different, first of all, which is not. So I don't buy that. It's the narrative we hear all the time. We hear it again and again. This time is different. And then something comes up, and then we see that it's not different. The cycle, probably holds. And I think, within the next 50 days, you could probably see a top of the Bitcoin, and it could be a much higher level, as I said, than where we are now. But I also see that the business cycle is rolling over at this time. So that's quite different. And I think that what I see technically in Bitcoin, that this is a massive top you have here. This is not a cyclical top. This is a secular top in Bitcoin, which means that we are you can see it's crashing to much, much lower levels than most people can understand. So this time is different with the ETFs and all that. Take the .com, narratives and put it in, and put the digitals, sprinkle on it, and you have the narratives of today. It's really about the real economy. The real economy is rolling over, and I cannot emphasize that more. When it does that, there's no going back. The risk assets, and Bitcoin is a risk asset, will crash. So you're going to see Bitcoin is going to have a very good time for the next few weeks here until the top, and also with the cycle. And then I think it's going to be a really, really bad asset to hold for the next few years. And then we'll have to see, because I can only see down the road that the Fed will come back in again. But if you look at it, what they have done is, as I said before, they have reintroduced inflation. What do I mean about that? If you look at a chart, a 10-year yield chart for the last 100 years, you can see how the cycle goes up and down in terms of yields, which follows inflation. And if you look at it, you can actually see momentum-wise that it shifts in 3 phases. So from the 20s until the 70s, after the Second World War into the 70s, you had an inflationary trend. Then Volcker came out, and you had a deflationary trend. And now we are actually at the bottoming end of this, and we see that we have a significant shift in the momentum. That's why the Jeff Goldblacks and so on are telling us that they're going to short the bond market, because in the long time frame here, they see that yields will go higher. If that happens, you are in a completely new setup from what we've seen over the last 5 to 10 years. You are now in an inflationary environment. I mean, just think about what our grandparents would say, or our parents would say back in the 70s. If you say, you know what, every time the economy rolls over, we'll just the tiniest bit, we'll just sprinkle some liquidity on it, a lot of it actually, and more, and everything will be fine. You know what they will tell us? They will say to us, how can you do that? You'll get inflation. Why would you do that? Then you'll get inflation. You'll crush the consumer even more. And this is what people do not understand. That is really what is different this time, is that we have reintroduced inflation with the stimulating into COVID in a crazy manner when the supply chain was actually breaking down. That was the inverted Volcker moment, which reintroduces inflation on a secular basis. And in that world, you cannot sprinkle liquidity on everything and just get a better outlook. So I think you're going to see the Fed come in, and excuse me. And then they will try to do the same thing again, but they're going to find out that the free lunch is over. The free lunch is over now. There's inflation that actually will kick up, not immediately. They may do a bounce in the market, and the euphoria may come out for some time. But in the longer time frame, I think you're going to see something that is much, much worse. And that is an economy that is not reacting to stimulus, because Mrs. Johnson there, she doesn't go and borrow that $100 extra. And that means that the stimulus packages on the QE side will not help. They will not be as stimulative, and they will not really help to turn the economy. But what we'll see is that the money that starts to be injected will start circulating faster, and that creates inflation. I think it's critical that we study and understand where you had to invest if you were in the 1940s. First of all, we're not going to, we still have the big shakeout thing. So we're not really in the 1950s phase, but coming that big shakeout that I think we're going to see in the markets and so on, you'll have to study what you should have been investing in the 1950s when you had an economy that was starting to grow again. But we are not really there. And that's why I think the whipsaw effect of what we can see now is going to be quite difficult to navigate in. I think you're going to see now the blow off top everybody will be a genius because they are long Bitcoin or long something, some crypto. And then they will realize that there is a top to these things, and they can actually crash quite a lot. And a lot of people will be not so happy about that. And you can see yields coming down strongly in the deflationary phase, the dollar strengthening to extreme highs. I mean, I see in that phase the dollar hitting 117 on the Dixie. 120 even. So it'll be a lot of headwind. And then you'll see the Fed coming in, trying to crush the dollar, and they will be very, very, very successful. And then you'll see it'll be completely different. So it depends on where you're on these phases. And the first phase, the first deflationary phase, it's not going to be years. That's what I'm talking about. I'm talking about 6-9 months, but it's going to be severe. But the next phase, when they come in, they step in, and the stagflationary part, which is when inflation starts to move up and the stimulus is not, when inflation starts to move up and stimulus doesn't really work, well, that is the phase which will be very difficult for a lot of people. And the only thing that really will do well there is hard assets. It's commodities. It's gold and silver at that point, which may not do so well in the deflationary phase. And then we need to see what happens after, because I cannot see how this ends without a monetary reset at some point, where they simply clean up this mess that we have right now in terms of money printing, crypto all over the place, and speculation about what will be the next foundation for the global financial system, and so on. It will not just be left up in the air. It cannot, because by the end of the day, we need a sound monetary system to build things on. 1944 was the turning point after the Second World War. Debt was ballooning and so on. We needed a stable foundation. The US came out, said, hey, we have half the production of the world. We have half the gold reserves. You will be able to take our dollar bills, and you can transfer them into or convert them into gold any day you want. That was the stability. That was what the world was looking for. So we could use that to trade and to go forward. That kind of cleanup is needed before we really see the things going. The world starting to grow in a real manner again. Because what we've seen over the last many years are stimulated growth. Now let's pump money into it. Stock prices goes up. What's not to like? Well, look at the consumer. They don't like it. And that's the real problem.
The narrative that this time is different, that ETFs, institutional adoption, or new digital trends will support prices indefinitely, echoes past bubbles. Zeberg urges investors to remember that Bitcoin, like tech stocks in 2000, is ultimately a risk asset dependent on liquidity, not a safe haven immune to downturns.